Next heading is investment in associates. Investment in associates. The typical shareholding in this category is 20 to 50%, and the method of accounting that we use is equity method. So there are 6 small subcomponents in equity that we need to look at. First, we need to look at the basics of accounting method. Then what if the cost that you're paying to acquire that company, I mean those shares, is more than the book value of those acquirees' assets. That means book value of the assets is 100. You're acquiring, let us say, 30%. So ideally you should be paying 30. What if you pay 40? Then how do you do accounting for that additional 10? So this is the second component. Then what happens to that additional component? So we typically amortize, which is 0.3. Fair value option available in US GAAP, IFRS, impairment of these securities, and transaction with associates. Okay, so let's do step by step. I'm building a comprehensive example here. So 2 balance sheets. The first balance sheet is of investor. The second balance sheet is of investee, the one in which we are going to invest. The first example is going to be relatively easier to manage. So on the left of your balance sheet, I am going to write liabilities and equity, equity and liability. On the right, we are going to have assets. Equity and liability. On the right, we are going to have assets. Now, let us say for investor, right now equity is 1000. Accumulated reserves are 5000. They have a bank loan of 5000. Balance sheet total 11,000. Then they have plant and machinery 6,000. Cash 5,000. Balance sheet total 11,000. This is the balance sheet of the investor. Now investee, they have plant and machinery 1,000. They have inventory 2,000. Cash additional 1,000. Total 4,000. Bank loan 2,000. Equity 2,000. Total 4,000. Investor has decided to acquire 30% stake. Investor has decided to acquire 30% stake in investee, and for ease of reference right now, because it is the first question, that deal is happening at a price of 600. You can observe that 600 is actually 30% of 2000, which is the equity. Now how do you prepare a revised balance sheet? The method we are using now is the equity method. Nothing changes on the left hand side. Equity still remains 1000. Maybe you just observe for a minute. So just observe carefully now what's happening. Equity is 1000. I am preparing a combined balance sheet. Reserves 5000. Nothing changes here. Bank loan 5,000, absolutely nothing changes here. Total is 11,000. Then next, assets, plant and machinery 6,000, nothing changed. We are not bringing in the assets of the investee onto our balance sheet, but your cash, which was originally 5,000, now it will reduce by 2,000 and it will become 3,000. And then we will have a sub line item here which we will call investment in associates. Investment in associates, which would be 2,000. And that's how the total of the balance sheet is 11,000. Now let us assume the market value of those 30% shares, market value of those 30% shares is, let us say, 1900. So those market value of the shares is to be completely ignored. In case of investment in associates, that investment will always be shown as just a single line item. So no matter what variations you see on the exam, it will never happen that investment in associates would be shown in different components. It would always be shown as a single line item. Are we fine with this? So this is a base case example. Write down this quickly. Oh, it's my mistake, sorry. This was 600. That was a gross one. And this is 600. So this is 4,600. 4,400. And this is 1111. Everything else remains same. So this 1600 is too much. Sorry, 1900. Let's change this to 400. So we assume that there is a valuation premium. Have you finished writing this? Now next year. So now I'm preparing an income statement for investee. Income statement of investee. Now what happens is, next year investee makes sales of 10,000. It incurs a cost of 5,000. So profit before tax 5,000. It pays taxes of 2,500. Net profit 2,500. Out of this 2,500, it decides to pay a dividend of 1,250. Okay, this is what is happening in the books of investee subsequent year. Now those transactions on the books of investee, we have to bring them in the books of investor. So the logic you have to use here, that again I'll give you time, just observe. Your investee has made profit of 2,500. 30% of that profit belongs to us. So we will see in the books of, so this is the income statement here. And in the books of your investor, whatever is your profit, to which we will add towards the bottom, profit from investee 600. Are you for again? Profit from investee 750. How is this 750? 2,500 into 30%. Now the moment you show this profit from investee, technically 750 should be added to your reserves. Agree? 750 gets added to your reserves on this side, and this 750 will also increase the value of your investment, because in a way now that associate is becoming more valuable. Are you following this? And right now I'm not considering dividend up to now. So that 750 profit is your profit. So that is your on the income statement, which goes to equity, plus it increases the value of investment. But half of that is paid to you in cash. So on income statement, that dividend of 375 will not be recorded separately. because you have already recorded income of 750. So if you record dividend of 375, you would end up recording the same income twice. Are you following this? What we do is that 375 we will reduce from the value of investment here, and 375 would be added to your cash here. So the proportionate share of profit that gets added to your profit, and it gets added to the value of investment. But proportionate share of dividend, that is not added to profit, that is simply added to the cash, and it is reduced from the value of investment. Are we good with this? So please write now. This is your income statement. So on the income statement of investor, that 375 is not recognized. So that would, in the presentation, you will say unrealized increase in profit 375, dividend 375. But for level 2 exams, it will become complicated. So just say 750 gets recognized, 375 does not come on income statement. That is a much more easier way to approach. Do you want me to repeat this again? Dividend part. So, see, now think of it this way. Have you finished writing this? Okay, let me repeat this one more time. It's not difficult, just try to think through this. We are saying investment in associates, which means we are looking at this as a business partner, an extended part of your firm. So we do not really worry about market price of that stock. We completely ignore it. First, we recorded that as a single line item, which was equal to amount that we paid. Then that single line item will increase if the valuation of your associate increases, or book value of the associate increases, and book value of the associate will increase if it's making profit. So first year it made a profit of 2500. 30% of that profit is yours because you own 30% of that company. So you said that benefit of profit in your books is of 750. Now the firm decided to pay half of that profit to you in cash. Agree? So if you recognize that 375 as income again, you would end up recognizing the same income twice, because that 750 includes 375. So that 375 you don't show on income statement. But then how do you record that? You add that to cash, where it will reduce the value of investment. And that makes sense because the accumulated profit of the investee is 1250, not 2500. है ना? So investee का book value 1250 से increase हो रहा है. Investee's book value is increasing by 1250. So your investment should also increase by 30% of that amount. समझ में आया? और एक करना है? और एक same, do you want to do similar one? Let's do it quickly. So in fact, now what I'll do is, I will prepare a balance sheet and income statement. So this is balance sheet of investor, and this is income statement of investor, without considering the impact of financials of investee for this year. Okay? So equity is 10,000. Equity is 10,000. Bank loan 20,000. This is 30,000. Then here you have some random asset. Let's say building 20,000. Read this as 20,000, please. And investment in associates 10,000. The single line item. So this is 30. Okay, but here the assumption is this year's impact has not been considered into this line item. That's what we want to learn. Then what is your income statement? Your sales is of 20. your cost is of 10, your taxes are of 5, and therefore your net profit is of 5. Now the income statement of investee. Sales 8,000, cost 2,000, taxes 3,000, profit before tax, यहाँ पे टैक्स कितना लिया था 50, सो प्रॉफिट आफ्टर टैक्स 1500, प्रॉफिट आफ्टर टैक्स 1500, and let us say dividend paid is 600. Assume that क्या हुआ? 6 3, PAT is 3, PAT is 3, dividend 1200. Let us assume that investor has a 40% ownership, in the investee. So what I want you to do is create a new balance sheet considering the impact of profit and loss account of the investee, and also find out the impact on net profit. Have you understood the question? Start. Okay. Now I'm doing the impacts here. Step number 1, that we should get some benefit of these profits of 3,000. Since our ownership is 40%, our net profit will increase by 1200. Now because your net profit increased by 1200, that 1200 will come on to your equities. So 1200 gets added here into your equities through routing through your profit and loss account, and 1200, the proportionate share, gets added to your investments. Is that fine? So that's the first impact. Proportionate share of profit we add to the investment, and we add to that our profits. Second, we've received dividend of 480. So when you receive the dividend, you will create a cash item here. So you will say cash 480, and that will reduce the value of your investment by 480. That's it. That means that 480 was not separately recognized on the income statement. Easier? So this is a basic methodology. Now, do you want me to help you write down the steps? Yes, no? Okay, good. So should we go to one step advanced from here? So give heading. The question she is asked, what if there was a loss instead of profit? Then how do we do treatment? Treatment is same. Now the proportionate loss will go to your income statement and reduce your profits, and it will reduce the value of investment. Now what happens is, imagine if every year there is a loss. So at some stage that investment in associates will become 0. After becoming 0, if next year again there is a loss, then should you show that investment is negative? So then what you do is you stop there. You just show it as 0. But you keep on recording those accumulated negative losses into your notes. Then the year in which it starts making profit, you first set off all previous accumulated losses. After that, if there is profit, again the line starts appearing, investment in associates, a positive number. Have you followed this? So you reduce it twice. The question Maulesh asked, if investor is making losses and he is still giving dividend, then the loss proportionate share is to be reduced on your income statement, on your investment line. and the dividend to be reduced in investment line and added to the cash. So reduce dividend, add profits, reduce losses. No, no, because this is not a financial investment. Had it been a financial investment, that dividend is your earning. It's like this. So the way you think of this, you have a piece of land. You have ownership of this piece of land. This is worth 100. Now next year, the valuation of that land becomes 80. So you should ideally recognize a loss of 20. But what you decided, a small piece of land is to be sold, that might get you a cash of 30. But that cash of 30 is not your profit. It is just you're selling some part of your land and getting that cash. So irrespective of what happens, your loss is still going to be 20. Should I repeat this again? Do you, it will. Do you want me to repeat this? So it's not so difficult. Your associate is nothing but a box of assets. Let us say valuation of that box right now is 100 and you have a 40% ownership. So you show that worth as 40 in your books. Okay. Now next year the associate makes a loss of 20. Loss of 20. So because it made loss of 20, now it is worth how much? Only 80. So with 40% stake, how much should that be in your books now? In your books it would be 32. So what you did is you actually reduced those 8 losses. Are you following this? Now what the firm did, it also paid a dividend of 10. So when it pays, and in fact let me make it 20. So less dividend of 20. So when it pays dividend of 20, it becomes how much? 60. So in your books it should be how much? 24. So you also reduce the dividend of 8. Are you following this? But as far as your income statement is concerned, only this 8 will go to income statement, which was a reduction in value. This 8 offsetting entry would be plus 8 in the cash. So the logic is that investment is not a financial investment anymore, it is an associate. So when it pays dividend, that's not your income. It's just selling some part of it and giving you in cash. The income will happen only if it makes profit. Are you fine with this? Yeah. You wanted to ask something? Should we go ahead then? Okay. So next heading, investment cost above net book value of investing. Investment cost above net book value of investing. It's going to look a little fancy at the beginning, but eventually you would feel comfortable with this. Investment cost above net book value of investing. Done writing? So again, I'm building balance sheets. So here on the left we have investor. On the right we have investing. Let me do the investor first. Equity 20. Some building here 10. Cash 10. Equity 20. Building 10. Cash 10. Investee, we would need little more assets here. So equity 5,000, building 1,000, furniture 1,000, inventory 1,000, cash 2,000. Now this time investor acquires a 40% stake in investee and pays a premium of 2,500. Now the difference between the previous question and this question is, last time the amount paid was exactly proportionate to the book value of equity. This time we are paying a little bit more. Now let us assume, building, furniture, inventory, cash. Let us assume that market value of this building is 1500 and market value of the furniture is 1250. So these are the fair values. Are we fine here? The life of the building is assumed to be of 10 years. Okay, I'm just trying to put two concepts into the same example. And life of the furniture is assumed to be 5 years. Life of the building is 10 years, life of the furniture is 5 years. Now listen to me carefully here. We want to basically find out the composition of this 2500. So how do we do this? Out of that 2500, 2000 is paid towards the book value of the investee. Easy? So 5000 is the equity, 40% of that 2000 is book value of investee. Then 500 is the excess of fair value of building over book value. So book value is 1000 and fair value is 1500. So that excess is 500. We are just buying 40% of that. So 200 we paid towards excess of that fair value over book value for building. Are we together? Then 250 is excess of fair value over book value for furniture. So that 250 into 40%, 100 we paid towards furniture. And finally, how much are we left with? 200. So that 200 we paid towards goodwill. So anything that is left after assigning that excess towards fair value, that is simply assigned to the goodwill. Is that fine? So write down this decomposition. This is just the beginning of this discussion. Let me make one more attempt at this. Have you finished writing? The book value of investee is 5000. 40% of that book value, ideally we should have paid how much? 2000. But we've paid how much? 500. 2500. So we are trying to assign that excess 500 to different assets. So that 2000 is gone towards book value. Then we start assigning those excess to building value. So we say that building's market value was 500 more. And in a way, we are acquiring 40% of that building. So maybe we paid that 200 because we knew that building is worth 1500, not 1000. Right? So we paid 40% of that 500. In the same fashion, we paid 40% of that 250. So we paid 100 towards the furniture. So then we should have paid 2300. The reason why we still paid that 200 extra, because that 200 is now considered as the goodwill. Is that okay now? Now once this is done, then how does it get recorded in the books? Should I clear off this part? Same example, but how does it get recorded in the books? So now I'm preparing a revised balance sheet. So now on this revised balance sheet, your equity is still 20. Your building, how much do you think it should be this time? Your building, 10,200. Your building is still 10,000. Then we will have cash, which is 7,500. Investment in associates, 2,500. Even now, we do not have more than one line item on the balance sheet. No matter whether we are paying goodwill, we are not paying goodwill, whether we are assigning excess to fair value or not assigning fair value, your balance sheet item would always be a single line. But this time we know as accountants that 2500 is made of 4 separate parts. So which were those parts? 2000 towards book value, plus 200 towards excess of building, plus 100 towards excess of furniture, and 200 towards excess of goodwill. It is everything, the decomposition is written in the notes. This is just the beginning. We are yet to go on income statement. Is it done? Are we together on this? So what we are concluding so far, if you have paid more, assign that excess to the fair values, and after that, even after that, if some amount is left, assign that to goodwill. Now, let us prepare the income statement. The income statement of the investee. Okay, so now this is income statement of investee. We are assuming this is by the end of that year. By the end of that year. Sales, $5,000. Depreciation. So I'm cutting down on all other expenses. Depreciation. What was the value of building in books? 1,000. And what was the life? 10. So 100 is the depreciation on building. 1,000 divided by 10. This is the books of investee. Are we together? Plus, what was the value of furniture? 1,000. And life? 5 years. So 200 is the depreciation of furniture. So your total depreciation 300. Let me create other expenses of 700 just to round it off. So your profit 4,000, taxes 2,000, net profit 2,000. Are we together on this? Now, ideally what we should be doing is that this 40% of this 2,000 should be added to our investment, and 40% of this 2,000 should be added to equity. This is what we did in the previous question, but not in this one, because that excess of 500 is not depreciated in the books of investee. So now in our books we'll have to depreciate that excess of 500. In our books we'll have to depreciate that excess of 250. So now what will happen is, you will say proportionate share of profit, 2,000 into 40%, how much? And again the idea is, don't remember, try to build concept around it. Profit of that investee is 2,000. So profit of the investee 2,000, 40% of that, our profit is 800. Now what happens is, in our profit of 800, we haven't considered depreciation on that excess of assets. So what was the composition? Out of that 2500, 2000 was book value. Then 200 was building, 100 was furniture, and 200 was goodwill. So that 200 of building, that needs to be depreciated in our books for remaining life 10 years. So we depreciated 20. And that 100 of furniture, it had a life of 5 years. So again depreciation of 20. And then only 760, is this correct? Yes, only 760 is what we add to investments, and 760 is what we add to profits. Yeah, so remaining part won't be depreciated, which is fine because we do accounting on historical cost basis. So in the books of investee, it would charge depreciation on what was the book value of assets. But in the books of investor, the book value of the asset is the fair value on the rate of purchase. So therefore he is also charging 40% of that excess as depreciation. Want to do one more? So I have a few examples with me. Okay, I'm running through the theory quickly. Significant influence 20 to 50%. Now there are alternative definitions of significant influence. Representation on the board, policy making, material transactions, interchange of managerial personnel, technological dependency. So what is this? It says maybe your stake would be 80%, 18%, but you still will have significant influence if one of these things exist. So what are one of those things? That the investor has a representation on the board of directors. Are you following this? Then it is a significant influence. Or investor has an opportunity to make decisions. So when does it happen? It happens again, automobile component suppliers. Right? So most of the time these are funded by the automobile company. So if there's a supplier, then Bajaj Auto will give him a loan of 20 lakhs, 30 lakhs, 50 lakhs. And then Bajaj Auto will decide what is the quantity to be manufactured, at what price to be manufactured. So even if there is no significant equity, they will still have a participation in the policy making. Material transaction between the two parties, interchange of managerial person, technological dependency. So read this as all those the contract manufacturers for Hindustan Unilever or all other companies. So they are completely dependent on the technology provided by these big companies. So all these are into this category. Yeah, so what he says is, what if the investment is above 20%, but the intention is pure investment? I mean, the intention is not to have significant influence. Then we will still use financial asset method. So this 20 to 50 is just an indication. The true test is whether we have a significant influence. But what happens is, if you have such a large investment, then every special resolution you would require approval of that investor. So you would end up becoming one of these. Okay, moving forward. So these were the steps. Record this on cost. Then proportionate share of earnings. So in case if you missed it the last time, observe now. Proportionate share show on the income statement and add to the investment account. Then dividend received, add this to the cash, reduce from the investment account. Understand that income shown on income statement is proportionate share of investor's income. Dividend received does not go to income statement. Convinced with this? Okay. Then for the exams, again, don't need to write. I'll tell you whenever it's important. Change in the market value will not affect financials. So very common trap on the case studies. They will say use equity method, and they will also give you a chart of market prices. Market price was this, then this. That is completely irrelevant. Second, if value is reduced to 0, then we will discontinue equity method. When will it reduce to 0? If you are booking losses every year. So if you book losses, then it becomes 0. If there are subsequent profits, Then we will resume after all previous losses are absorbed. So first tell me what should be the value on balance sheet. So how you would easily do it? Original investment is 10,000. Then first year earning of 4,000 and dividend of 1,000. So what is the net retained earnings? 3,000. 30% of this 3,900 gets added here. Agreed? Next year 6,000, 1,500, so 4,500. 30% of that is 1,350. That gets added here, and how much is that? 12,250. That should be the value of investment. Is that clear? Then how much would be your reported income in 2006 from the investee? How much? 1,200. That's simply 30% of 4,000. How much Harish in year 7? 1,800. So again, that is your reported income here. So this is how you do on the income statement. Now on the cash flow statement, in year 1 in 2005, we will have an outflow of 10,000, which would be CFI, because that is your investment. In 2006, we will have an inflow of 300, and that inflow would be so पहले US गैप बोलो. CFO or CFI, and if it's IFRS then CFI. Next year the inflow would be of 450, again same. Are we good? So you're receiving dividend, only dividend is your inflow, that profit is not your inflow. Okay. Then investment cost above the net book value. When the cost of investment exceeds the proportionate share of net identifiable asset. So I'm yet to do a tricky question on this, similar to one on the mocks, but we'll keep that on hold. The differences are allocated first to fair value of net identifiable assets amortized over useful life. Excess of differences in then treated as goodwill, which is not amortized, which is tested for impairment. Is that okay? Okay. Then again, investment would be reported as a single line item. Some of you might find this part a little difficult, but see if you can get this. Over a period of time, balance in the investment account will come closer to percentage of book value of assets of the associate. So once you charge depreciation, so it would never be precise, but it would start inching closer, because every year your investment is increasing in proportionate to retained earnings, right? So as you go further, the impact of that differences which were created initially, that impact will start becoming smaller. So over time, this percentage will start getting closer. And if you haven't understood this, it's fine, it's not testable. Then amortization of excess purchase price. So amortize over useful life. What you do not amortize is land and goodwill. So we have an example. Amar is very happy. Yes, Manoj. How much goodwill? 60. Let's do it together. Even if you haven't understood, focus now. It's not at all difficult. So first, what is the amount we have paid? Amount is 180,000. This we have to divide into different components. What is the book value of the investee? Book value means value as per the balance sheet. So book value is 300,000, but we are buying what stake? 30%. So 90,000 gets assigned to the book value. So what you're essentially saying is out of 180, 90 is paid towards book value. Is that fine? Now there is one asset whose book value was 25, but market value is 125. So excess of that value is how much? 100. But we are just buying 30% of that. So 30,000 gets assigned to excess of equipment over the book value. And then whatever is left, so how much is left? 90 plus 30, that's 120. Whatever is left, 60, which is your balancing figure, this we will assign to goodwill. And then it is this 30,000 that we have to depreciate separately over and above what depreciation we have in the books of investee. And we would depreciate that over what life? They've given in the question 10 years. So that was your part 1. So calculate goodwill, this is done. Second, White Walker's income from investment in HS. So how do we do it? First year income is how much? Manoj, first year income is 100,000. Our share is how much? 30%. So our income is how much? 30,000. But that excess of fair value that we assign, that also needs to be depreciated. How much was that excess? 3,000. And what is the life of that asset? 10. So this 3,000 needs to be assigned, and therefore we get 27,000. Is that fine? Then what is the value of investment by the end of the year? So you start with 180. Then you would say plus 27, correct, which is your proportionate net income minus the depreciation, minus 18,000 which you received in the form of dividend. Manoj, so that's 60 into 30%. And then we will have the net value on the investment, net value on the balance sheet. Easy?
So why is the requirement of
It is recorded, it is not disclosed separately. अभी example करें. Do you want me to scale up a level a little bit? So let's do this one now. Equity 50,000. Building 30. Just cutting down on the other components. Cash 20. Equity 20,000. Goodwill 5,000. Building 5,000. Cash 5,000. और कुछ रह गया ना? Inventory 5,000. Now we are going to acquire a 40% stake, and to acquire that 40% stake we are going to pay an amount of 15,000. The fair market value of this goodwill is 7,000. The fair market value of building is 10,000. Now calculate how much is the goodwill in the transaction. That means how much of that 15,000 is towards the goodwill. वो आपका तुक्का लगा है, वो आपका लिखा है, इसको मैं 8 कर देता हूँ. Just to avoid confusion, I am making this as 8. I am making that goodwill as 8. The answer doesn't change. 5,000. So what you do now is, step number 1, you find out what is the book value. Now if you read the CFA text closely, it actually says book value of identifiable assets. So which means when we are referring to book value, we completely ignore goodwill on the investor's balance sheet. So here this is 5 plus 5 10 plus 5 15. Your book value is 15,000. You are acquiring 40%, so the amount that you assign to book value is 6,000. Then excess of fair value over book value. So that we consider only for building, we don't consider that for goodwill. So that would be 5,000 into 40%, that is 2,000. And then the balancing figure, which has to be 7,000, which is your goodwill. Same question. The only thing that changed, when we calculated book value, we considered only identifiable asset. Can you tell me why goodwill is considered as a non-identifiable? Why is goodwill a non-identifiable asset? No, not because it's intangible. It cannot be sold separately. So think of any other asset. You can sell the asset, you can still do the business. But if you sell goodwill, you are out of business. So therefore it is that asset which you cannot sell separately, and therefore it is a non-identifiable asset. So patent, copyrights, trademarks, these are identifiable, these are intangible assets, but they are identifiable assets. Goodwill is a non-identifiable asset. Are we fine here? Have you understood the example? Should I repeat again? Okay. Alright, then this is what you would want to write: fair value option. Fair value means you just don't trouble your accountant with so much of ifs and buts. You simply let them record the investment at market value. So the treatment is similar to trading account. The way you treat your trading investment: on balance sheet fair value, on income statement realized, unrealized, both the gains. But it is not available to everyone. So in US GAAP, everyone can do it, but in IFRS only the financial companies, venture capital or MF or unit trust. And now there is no question of goodwill. So if one of us become an accountant, and if the company has investment in associates, the first thing we should do is go to the CFO and convince him why fair value is a good idea. Because if that is the case, then you don't have to worry about any of the equity method transactions. Simply record them at market value, and all gains directly go into your income statement. Transaction with associates, इसी का part है, last part है. After this we are done with this section. Transaction with associates. So there are upstream and downstream, two types of transaction. Upstream and downstream. So so this is investor, this is investee. So when an investee sells to the investor, we will call this as an upstream transaction. When an investor will sell to the investee, we will call this as a downstream transaction. So investee selling to investor, upstream; investor selling to investee, downstream. Now the good news for you is the accounting is going to be more or less similar on both the sides. So you don't have to remember separate treatments. So investee sold some goods to investor. By selling that good, it made a profit of 10,000. It made a profit of 10,000. Now, investor in turn sold half of those goods. Okay. So investee sold to investor. That means your own associate is selling to you, and you in turn took those goods and did whatever process you wanted to do, and you have sold half of them. So what we say is that out of that profit of 10,000, we will say confirmed profit. Confirmed profit is how much? 5,000. Why confirmed? Because when investee selling to investor and investor selling further is same as investee selling directly to outsiders. A is investee, B is investor, C is outsider. So A sold to B, B sold to C. That means in a way A sold to C. So we are only worried about that part of the profit which is unconfirmed. So out of that 10,000, 5,000 is anyways confirmed. Now what has happened is, out of that 5,000, let's assume a stake of 40%, 2,000 is currently recognized in the books of investor. So that 2,000 needs to be reversed, and we should make that as 0. Investor has a 40% stake. So whatever profit investor will do, whatever profit investor will make, 40% of that profit is on investor's financials. But the rule is you should not make profit by selling to yourself. And you cannot make profit just by selling to yourself. So now what has happened here? We have recognized a profit of 4,000. How? That's 40% of that 10,000. But out of that 4,000, 2,000 worth of profit is actually the profit that you have recognized just by selling to yourself, because that's the unconfirmed profit. So we will say minus 2,000 and then 2,000. But as far as your exams is concerned, this is what you need to know. We will have a offsetting entry of negative 2,000. Do you want me to? So investee sold 100 computers to investor. On each computer, it made a profit of 100. So total profit of investee is how much? Total profit is 10,000. Now, as far as investee's books are concerned, he doesn't care. He sold that to the investor. He will recognize a profit of 10,000. Investor has a 40% stake. So he got excited. He said 40% of that profit belongs to me. That means in my books, I am going to record 4,000. However, assuming there is no further sale, what he is actually doing is, think of that investee as a part of investor itself. Correct? So that 10,000 profit is recognized just by selling to yourself. It's like in a business, you have two business division, one selling to another and showing a profit of 10, but that's not a true profit. The profit will come to you when you actually sell this to outsiders. So if investor is not able to sell this outside, then we will reverse that entire 4,000. We will say it is unrealized profit, do not record. But what if investor was able to sell 50 of those computers? Then the way you think of this is that investee has sold 50 to outsiders and 50 to investor. ठीक है ना? Investor ने 50, investor sold 50 to outsider. So investee has sold 50 to outsider, 50 to investor. So he has made a profit of 5,000 just by selling to himself. And in that case, we reduce 40% of that 2,000. And if you feel nothing of this makes sense, then the easiest way is find out total unconfirmed profit into multiply with percentage of shareholding and simply reduce that from the profit of investor. You're done. Total unconfirmed profit. Unconfirmed means that which is not sold further, multiplied by percentage stake. Is it fine now? The other side here. Now investor sold to investee and investor recognized a profit of 10,000. Investee sold half of that to outsiders. I'm repeating again. Investor sold to investee. Investee sold half of that to outsiders. So the way we can think of this, that half of that 10,000 is actually sold by investor to outsider. So only 5,000 of that profit is what investor has earned by selling to investee. But 30% of investee is actually you, or 40% of that investee is you. And you cannot make profit by selling to yourself. So again you reduce 40% and you will say minus 2,000. नहीं है? Okay, one more attempt. This is A. This is B. So in fact, yeah, this is B. B is made of two parts. B is made of 40% of A, 60% of outsiders. B ka shareholding, 40% A, 60% outsiders. And this is C. A sold to B goods worth 10,000. मतलब profit जो भी 100 computers बेच के profit of 10,000. B sold to C half of those goods. So that means in this process he made a profit of 5,000. So what it actually means is कि ये जो profit 10,000 का है, 10,000 में से 5,000 का profit is A sold to C और 5,000 का profit A sold to B. But 40% of B is A. So we have no problem with this profit. We are all good because A sold to C. But when A is selling to B and B is nothing but some part of A, so you are in a way having some part of that profit just by selling to yourself. So what you do is you try to eliminate that profit, so which is 2,000. And if you still feel you have not understood anything out of this, then as far as exams is concerned, it's very simple. First you find out total profit, then you find out percentage which is unconfirmed. Unconfirmed means the one which is not sold further, and you multiply that with the percentage shareholding, and that profit is to be reversed in the books of investor. Whether it's upstream, whether it's downstream, the calculations are same. Is it fine? Okay. Next heading, impairment, equity method. And in equity method we have investment in associates as a single line item. Now the question is that if you are not using the fair value system, if you are using the equity method, then should we impair? The answer is yes, if in IFRS there is a loss event. Now what is that loss event? Don't worry about that. If you know this much is more than sufficient. In US GAAP we will, if your fair value of those investments is less than the carrying value, right? And there is a high probability that in most of the cases it would be like that. For example, in your books that investment is shown at a price of 10,000, But in the market, those number of shares are trading at a price of 8,000. So we will say that the fair value, the carrying value is more, fair value is less. But is that decrease permanent or temporary? If it is permanent, then we charge an impairment of 2. But if it is a temporary fluctuation, then we ignore. Other than temporary. Yeah, so that's technical definition of permanent. But how do you read this in practice? If some tangible business variable has changed, so a stock price can reduce maybe because there is a negative economic sentiment, or it can reduce because something went wrong with one of the plant of the company. So if something went wrong with one of the plant or manufacturing process or patent, then it's permanent. But if stock price reduce because of the market fluctuation, then it is temporary. Are we good here? But who decides that? It's the accountant who gets to decide whether it's permanent or other than temporary. Now, the loss will directly go to income statement, and reversal is prohibited both IFRS and US GAAP. Are we okay? So 10 minutes, we'll quickly summarize what we did, and then you're free to go. So it's an easy topic. Once you go through these examples carefully back at home, the good thing with this topic is you don't even need to revise this a day before the exams. Once you're clear about how numbers are moving from one place to another, you're done with this topic. So we started by saying either your investments could be passive or they could be active. In passive, we said investment in financial instruments. We divide them into 3 parts: HTM, AFS and trading, or designated to fair value. HTM on balance sheet we show at amortized cost. We understood that amortized cost is different than cost, and the YTM that we issue is always the YTM on issuance, not the current price. Then income statement we show realized income, but realized gain and received in cash gain are different concepts. So realized means what you have earned, not necessary all the time what you've received in cash. Right? So we looked at amortization of premium and amortization of discount there. Then nothing goes to OCI. In AFS on balance sheet we show fair value, income statement, realized, OCI, unrealized. There was a difference between IFRS and US GAAP. In IFRS, the foreign exchange gains go to income statement. In US GAAP, we do not differentiate forex gain and regular gains. We just put everything into OCI. In trading on balance sheet, we show it at fair value. On income statement, realized and unrealized gain. Then we looked at the reclassifications. So in IFRS, anything inside and outside designated through fair value is prohibited. You cannot do that. However, you can transfer from HTM to AFS or AFS to HTM. Both the transfers will happen at fair value. When you are HTM to AFS, the unrealized gain goes to OCI. When you're AFS to HTM, then the unrealized gain in OCI gets amortized to income statement. In US GAAP, you can transfer HTM to all the categories, and all transfers will happen at fair values. So if you don't remember income statement, that's fine, because anyways you would not with so many things. Then after that we went to investment into associates. Then we saw that investment in associate is always to be shown as a single line item. Every year that will increase by the proportionate profit, and every year that investment value will decrease by dividend. On income statement, whatever is your profit, that profit gets added by proportionate profit. And we also discussed that dividend is not to be considered on income statement, otherwise we end up doing double counting. And then what if we have assigned an excess value? So if you have paid an excess value, then that excess value first assigned to excess of fair value over book value of identifiable asset, and then after that if there is anything left, that is goodwill. However, on the balance sheet it is still a single line item. On the balance sheet we do not disclose it separately. That excess of fair value we need to depreciate every year. Are we fine?